We're going to talk about behavioral finance essentially today, and we're going to try to relate that to the financial crisis. According to Chairman Bernanke, what caused the financial crisis of 2007-2008 was the vulnerabilities before the crisis, in particular, the bad mortgage products and the practices. Of course, the real estate bubble. So we're going to look at this real estate bubble and how bubbles can be explained, and what are all the different theories that have been advanced to explain how bubbles form. And then there's some amplification mechanisms and some very large failures of banks, of insurance companies, and we're going to try to understand how these amplification mechanisms can work. So we do concentrate today on behavioral finance aspects, and this is basically where psychology and finance meet. You did have the reference in your syllabus about one article by Nicholas Burris about the psychology and the financial crisis of 2007-2008. Before we start with behavioral finance, what I'd like to do is to remind you of one of the main pillars of standard finance, which is the assumption of efficient markets. And I'm pretty sure that all of you already heard about that. Is that correct? But maybe some of you haven't yet, so I'm just going to recap very, very rapidly what it is to assume that markets are efficient. Basically, it means that there's no way you're going to find a $20 bills when you walk in the street. Why is that? Because somebody else already picked it up before you. When markets are efficient, all of the relevant information is automatically and instantly reflected into the prices on the market. So this is a very strong assumption, and this is an assumption that academics in finance have been working on for a very long time. And basically what it says is that you shouldn't waste your time reading the Wall Street Journal, because anything that you would learn in the Wall Street Journal is going to be already embedded into the prices. I'm not advising that, by the way. You shouldn't waste your time looking at past prices, and that's a very large category of people on the markets looking at past prices. This is called technical analysis. So technical analysis is trying to predict future prices by looking at the past prices and trying to infer something from the past and the way prices are going to behave in the future. So this would be also a waste of time with the assumption of efficient market and so on. Of course, when we're talking about behavioral finance, we're challenging this idea of efficient markets. And what I'd like to do is to start with a very simple example that is a real one that has been run by Financial Times in a long time ago, 1997. And this was a contest suggested by Richard Taylor. Richard Taylor is an economist and one of the founders of behavioral finance. And basically the contest was asking readers to choose a number between 0 and 100. Everybody would choose a number, and then Financial Times would compute the average number, and then the winning number would be the closest integer to 2/3 of the average entry. So let's try to figure out what number you should pick if you're playing this game. Assume that everybody first is choosing a number at random. If everybody is choosing a number at random, what's going to be the average number? 50. So 2/3 of 50 should be 33. So everybody should pick 33 because everybody can do this calculation. But then if everybody picks 33, what would be the new average number? 33, that would be the average number, but 2/3 of 33 would be 22. So everybody should pick 22, etc. Everybody can figure out that the winning number should be at the end, what do you think?
0,
1 actually, because 2/3 of 1, the closest integer is actually 1. So everybody should know, because we're assuming when markets are efficient, that also everybody is very smart and everybody can do these calculations. So everybody should choose 1 as the winning entry. What do you think was the winning entry? Do you think it was 1? No. It was actually 13. Why? Well, different explanations are possible. First explanation would be to say, well, everybody is really smart, everybody picked 1, but few people were actually choosing numbers at random because they were not smart enough to do these calculations, and then it actually took the average up, and then the 2/3 of the average ended up to be 13. And then you can say, well, maybe people are even smarter than that. Maybe people will anticipate that other people might not be smart enough and are going to make mistakes, so they shouldn't pick 1, but pick a higher number than 1, because they need to anticipate the mistakes of other people on the market. And even if you're really smart and you can figure out that it's 1, the winning entry, it should be 1, you're going to pick up a number that is higher than that. And of course, if you do that, you also pull the number up. At the end, this is a clear example that markets are not always efficient and that the winning entry is actually not 1. Yes, please.
Isn't that not really a market? I mean, there's no cost for the person to enter. It's like, I know when people play poker online, if they're playing with fake money, they make outrageous bets. And when they're playing with real money, they make much more calculated and more intelligent bets. So if you can enter something like that for free, I don't think it's going to, would it actually reflect?
Well, it needs to reflect, it's a market in the way that it needs to reflect the information that is available on the market. And here, you're right in the way that there's no exchange in this market, but that's a very rough example.
But if there's nothing pushing you towards being rational about your entry, I mean, it's kind of hard to
Well, the only thing pushing you to be rational about your entry is really to pick up the winning number. So that's a rough example, and that's an example where you see that the outcome of the game is not what would be rational if everybody was thinking exactly the way they should. A lot of other examples exist, and there is a huge case that is made against market efficiency on the market. The first one, and there would be a very long list of that, so I just picked some of them. The first one is that stock prices are too volatile. Why is that? Well, if you took some finance courses before, you know that stock prices should reflect present value of future dividends. If you look at these stock prices, that means that the volatility of the stock prices should be reflected by the volatility of the dividends. And when you're doing some more elaborated study on that, and this is something that you can sense from the markets themselves, the volatility of the dividend is pretty low, while the volatility of the stock prices is always extremely high. So there is some discrepancy here between dividend volatility and stock prices volatility. Stock market bubbles exist. Well, you're all aware about that. Of course, we can talk about stock market bubbles. We can also talk about real estate bubbles. We can talk about the late 90s with the stock market bubble for the tech stocks. Technology stocks were extremely high, and then it blew one day, and all the prices went down. Investors' mood, so we're going into psychology here. Investors' mood may drive prices away from their fair value. The real value is usually called the fair value of the stock. And depending on your mood, if you're more optimistic, if it's sunny out there, there's been some studies on that. It seems that the markets can be more bullish when there's sun. And if it's a rainy day, the market tends to be more bearish for no other reason than that. So the mood can actually have a direct impact on the markets, which, of course, it's not rational, as we like to call rationality. So what are today's questions? I'm looking at 4 different questions, and I'm going to spend way more time actually on the first one and then less and less time with all these questions. The first one is to explain market bubbles. And I'm going to try to find a rational explanation to market bubbles, but then I'm also going to try some psychological explanations to market bubbles. Then the second one is, why did the financial institutions take such large exposures? Chairman Bernanke talked about that. The exposures of these financial institutions were extremely risky. And it didn't seem rational to have these exposures that would potentially get these institutions bankrupt. So how can that happen? Can we find some behavioral explanations to that? Then what are the amplification mechanisms when the crisis comes? What triggers an amplification of the crisis? And then finally, a little words about regulation and behavioral issues. So I'm going to start with market bubbles, and I'm going to actually look at 2 different classes of theories. The first one is called a belief-based theory, and then the second one will be a preference-based theory. So the first class of theory is based on individuals' beliefs on what should happen on the market, while the second class will be based on their preferences. Let's start with an example, and that's the way I'm going to structure here the lecture. I'm always going to start with an example, and then we're going to try to understand what is the psychological principle behind it. Suppose that you have a stock that is currently traded only by the students in this class. Half of the class, maybe this half of the class, believes that the price should be $50. This half of the class believes that the price of the stock should be $30. You know that the way prices are determined by the market is through the law of supply and demand. So having different beliefs about what is the fair price is a good driver of the markets. I'm assuming here that short sales are not allowed. Does everybody know what is a short sale on the stock market? No, I see some no here. Yes and no's. So I'm assuming that some of you do and some don't. Let me try to explain that very rapidly. When you believe that the price should go down, what you'd like to do is to sell the stock. But it's not always possible because maybe you don't own the stock in your portfolio. So how can you sell something that you don't own? What you do is actually that you go and borrow this stock, and then you sell it. And later on, when the price goes down, as you believe suggested, you will buy it back on the market and give it back to the borrower, to the lender. So that's the mechanism for being able to sell something that you don't own. Short sales are actually very important on the markets. So what's going to happen here if short sales are not allowed? Well, the people who believe that the price should be $30, if the current price is $40, they would want to sell. But short sales are not allowed. Assume that nobody owns this stock in the classroom. So what's going to happen is that the price is going to be driven only by one class of individuals on the market. These are the bullish investors, the ones who believe that the price should go up. So what will probably be the equilibrium price in that particular case? What do you think? 50. It's going to go up, and only the bullish investors who believe that the price will go up are actually going to drive the price on the markets. So the price will then reflect the views of the bullish investors only. Clearly, that gives a rational explanation of market bubbles. When you don't allow short sales, only investors with bullish expectations on the prices will drive prices. Well, there's a clear example of that, which is with real estate. With real estate, you cannot short sell. You cannot short sell. You cannot borrow a house to sell it on the market and then repay it later on. It's just not something possible on the market. So with real estate market, by definition and construction, the way it functions, a real estate market is more prone to market bubbles. That's the first explanation, and it's actually not a behavioral explanation. So I still need to give you some rational explanations here, although that's not the intent of the lecture today. The intent of the lecture is really to go to the behavioral explanations. So we're going to move to the second belief-based explanation. And I'm going to ask you a question here. What is the number of countries in Africa as a percentage of all UN countries? Is it more than 7.5% or less than 7.5%? What do you think? Yep, Daniel.
I think it's A, because there are a lot of countries in Africa.
So it's more? You would choose A?
I choose A also.
You choose A? Emily? A? A? Not giving you the response right now. This is why I didn't want you to have the slides in advance, because that would be cheating. What is the number of countries in Africa as a percentage of all UN countries? It's the same question, but I'm not giving you two possibilities here. What do you think?
A little over a quarter.
What did you say?
7.5.
7.5?
I think like 26%.
Okay. Yeah, David?
About 12%.
12%? Now I'm giving you the answer. 24%, so you were pretty good. Most people respond to that about 10%, 12%, 15%. What is the psychological bias that I wanted to highlight here? Is the fact that there's some anchoring. Just because you had this number before of 7.5% is going to drive your response for the second question, because you have that in mind, and maybe that's a bad habit from school, actually, that you know that when you have an exam, there's a right answer. When you have multiple choice, there's a right answer in there, right? So I was giving you a multiple choice initially, maybe, and you thought that 7.5% had to do something with that. So there's some anchoring. There's some mental attachment to a specific number or to a specific price. Why is it important for market bubbles? Well, when house prices are going up 10% every year for a very long period of time, people tend to think that 10% is the right number. And they tend to be attached to this particular number, and they tend to think that it's going to go on forever with this 10%. The coin flipping contest, that's a pretty cool example. So we're going to assume here that there's 6 billion people on this planet. I know it's a little more now. It's 1 billion more plus. And we're going to assume that everybody's playing. Everybody's betting $1 on this game. Heads, you stay in. Tails, you're out. Very simple game. One person, everybody, I'm sorry, is flipping a coin here. And the game is very simple. You need to get heads as long as possible to be able to stay in the game. So after one round, there's basically 3 billion people who are still in. After 10 rounds, there's about 6 million people that are still in the game. Imagine you're flipping a coin and you get 10 heads in a row. That's pretty hard to get, right? So you got rid of a lot of people here. Only 1/1000 of the people are staying in. People start to believe that they're very good flippers. And maybe they're not just lucky, maybe they just know how to flip a coin. After 20 rounds, around 6,000 people only are left. You have to flip a coin 20 times in a row and get heads. Locals becomes heroes. And then you continue playing. After 25 rounds, 180 flippers are still around, on average, of course. If the game stopped now, you're just going to share all of the initial bets, you would get more than $33 million. These people write books about coin flipping. They're so good about coin flipping that they can take advantage of that, right? They're going to explain the strategy they have and how they can flip a coin. So they write books about that. And they have techniques and they have strategies, etc. It probably takes about 32 rounds to actually end the game with a maximum of 2 winners. So they would split the $6 billion initially. What's the question here? If you imagine there's only one winner, is the winner actually good at flipping? Or is it just pure luck?
He's cheating.
Cheating. We're assuming that there's no way to cheat. So assuming that there's no way to cheat, is it just pure luck? Well, it's very small probability, right? To get that, it's about 1 in 6 billion to get heads 32 times in a row. So is it just luck? Most probably. So if we're saying that this way, right, we can think that on the markets, sometimes it's just pure luck. When you play the lottery and you get the winning lottery ticket, maybe it's just pure luck, most probably, actually. At least with the flipping contest, you can think that you have something to do with that. With the lottery ticket, it's a little more difficult. What is it that I wanted to show here is the matter of over-extrapolation. So there's anchoring and there's over-extrapolation. When you're good at flipping, you think that you will continue to be good at flipping. When prices are going up, are they going to go up forever? People would think so. And that would create market prices. They want to be in. They don't want to miss that opportunity. They see house prices going up. They do want to participate in that. And they want to enjoy the ride like everybody else. So that's for the second belief-based explanation here. Third belief-based explanation. I have another example. Looking at the Dow Jones Industrial Average, one of the main index on the market. 2003, that's pretty old now, but I didn't want to redo all the calculations, so that's what I used. The market closed at 10,454. As a price index, you know, or now you know at least, that this does not include reinvested dividends. So it's only about the prices of the stock, the way the index is calculated. It never includes the reinvesting of dividends. Assume now that instead of not including the reinvested dividends, we were to include the reinvested dividends since the creation of the Dow Jones Industrial Average. So it was created in January 1929. And at that time, its value was 300. What do you think would be the value of the index at the closing of 2003 if we were to include all of the reinvested dividends? I'm asking you to give me your best guess, and then a low guess, and then a high guess. Yes?
Are you including all the companies that went bankrupt over that period as well? Or are you assuming that you're only reinvesting the actual amount?
Just the actual amount of dividends. So whatever it was defined, because the definition of the index is changing over time, depending on the different companies that are composing the index, whatever it was defined, we have just reinvesting dividends, and that's all. Does anybody has a best guess to start with? Yeah, just a guess, that's fine.
60,000.
60,000. Okay, so that's a best guess. I'm assuming that everybody would come up with a different one, but it really doesn't matter. So it's just a guess, right? 60,000. What about a low guess?
Said 20.
20? And what about a high guess?
Like 150.
150,000. And you're 90% confident that the answer lies between your low and high guess.
I tend to be overconfident. But yeah, let's say I'm 90% confident.
Okay, that's the answer. 251,000. Most people are first not well calibrated, but this was not an easy question anyway. It's a lot of calculation to come up with the number. But more than that, just what you said, overconfident. There's another example of overconfidence. How good of a driver are you? You're all driving in here, right? Are you above average or below average as a driver? Who's above average? Who's below average? When we ask this question to college students, 82% of college students are above average. Good illustration of overconfidence, right? And don't worry, it works with graduate students as well. I tried that. So that's overconfidence. And more than that, whenever you're trying to, like the best guess, although you didn't spend too much time on that, we were kind of rushed in that, but whenever you're putting some efforts into providing a guess, and sometimes it's a little complicated, you need to do calculations, you need to figure out exactly what the question is, you need to see what's coming in, the index definition, etc., etc. Whenever you're putting down some efforts in that, there's a natural tendency to overestimate the precision of the forecast. Why? Because you put some efforts in that. There's no way you're going to be that wrong. So the more efforts you're putting into a forecast, and the more you're going to assign pretty high probabilities that your own forecast is actually the good one. So now we're going to switch to preference-based explanations. Preference-based explanations, the first one, we're going to consider the following situations. First situation, you toss a coin again. Heads, you win $200. Tails, you lose $200. Who would take the gamble? Who would play? Only one person?
200 is a lot. People are trying to get more players.
If I had told you $2, probably you would have done it, right? But $200 might be a lot of money, right? And on average, what do you get? Zero, nothing, right? So it's a lot of risk, and it's a lot of money. So most people wouldn't play that. And this is what's happening in this class today. Assume now that you just won $1,000. And I'm offering you the same gamble. So you just have in your hands. It's important to have it in your hands, right? It's real. So you have it in your hands. You have $1,000 that you just won. And you're asking to play this gamble. Who's going to play? So not everybody, but way more people, right? So what are we seeing here? We're seeing that after experiencing some gains, although it should be exactly the same thing, right? The gamble by itself is exactly the same one. But because you just experienced some gains, more people are willing to take more risk. You know that casinos know that very well, right? Casino cannot be happier when somebody is winning because they know that this person will come back forever after the person wins. So you always remember that. You don't remember the times when you lost, actually, or you try to forget about that. But the time when you win, you will remember that, and you will advertise that to everybody, right? So I went to Vegas, and I got that amount of money. Of course, that's very important, because when you live in a house, and the price of the house is going up and up and up, and you're checking on Zero.com every day the price of your house, and you see that the price keeps going up, well, you want to take more risk because you're just winning by living in a house. In some cases, in a lot of cases actually, people were making more money by buying a house, living in a house, than going to their job every day. And of course, they want to be in the ride. So they're going to be willing to take more risk. What does it mean, being willing to take more risk on the real estate market? It means that maybe they will sell their house and get a huge mansion, and so they can win even more money. Or maybe they will stay in their house, but they will start buying more houses on the market just to enjoy the ride with everybody else. Second, preference-based explanation. Lottery tickets. Kind of talked about it already. You know that it costs $1. I think last week there was a huge lottery going on. You seem very aware of it. So assume probability of winning is 1 over 100 million. And when you win big. You win $60 million. Should anybody buy lottery tickets? What do you think?
Sure.
See a lot of people saying yes, and a lot saying no. Assume you're rational. Rational means that look at the return here that you're making. On average, what's going to be the return on this investment? You're investing $1, right? What's going to be the return? It's going to be negative. Why negative, right? There's only 1 over 100 million chances to get $60 million, right? So this is very negative return. Is there risk associated with this negative return? Huge risk. Standard deviation, right, is going to be huge. In other words, what you have here when you look at that as an investment, you have an investment here with a very negative return and a lot of risk. Well, if you took any finance course, you should know that this is not something that is liked in general, right? And on the financial markets, we're assuming that when investors are getting return, it's because high returns is because they're accepting to take some risk, but they want to be compensated for the risk that they're taking. So the more risk they would take, the higher the return on average they will require from this particular security. Obviously, with the lottery ticket, it doesn't work. But obviously, at the same time, a lot of people are buying lottery tickets. So we're kind of in trouble, right? We have some rationality definition that tells us that nobody should buy any lottery ticket, and then in practice, a lot of people are. Dylan?
But I think it simplifies it too much, though. For one, because people like a brand, that gives to charity, and all the money that's given to the government, which is about 50%, is given back to the state. So that's a positive outlook on that, which this model doesn't take into account. Also, when you buy a lottery ticket, it's not $60 million or $0. If you get like 2 numbers on the Powerball, then you get part of the money. So sometimes you bet, and then you do come out even. Just something to consider, because this doesn't.
That's right. This is simplified. But I can assure you that the return is negative.
I do believe you on that.
So even if this is simplified, the return is still negative. I am not sure that people are buying lottery tickets for charity purposes.
Not for charity.
But you can convince me of that, but I'm not quite sure it works that way. Although you're right, at the end, maybe that's a positive outcome of these lottery tickets. Did I have another question? Yes.
I mean, it could also be a positive investment. Like last week, the lottery was at 600 million. To get all the tickets, it would cost you 176 million. So some of the time and the resources to do that.
It's the probability is different in this situation.
And this is the good part, right? If you're winning once, or if you look at the person winning once, you think that you can be this person, so you're going to buy more lottery tickets. So it's a good marketing example, I suppose, for the governments. Did you have a question?
Oh, no,
Andrew?
I was just going to say, because 3 people won, so
Yeah. Anyway, what I wanted to show here was that there is a psychological factor, which is that the brain tends to overweight low probabilities. Basically, well, there's 2 things in here. First, $1 is a very small amount of money. So people would consider this $1 as play money. Even if they don't have a rational behavior, they can play with some small amounts. But also, 1/100 million's probability is something that the brain has a very hard time to comprehend. So this is such a low probability that probably it wouldn't make any difference if I were to tell you 1/1 millionth for the probability. It's so low that we're having a very hard time understanding what it means. And of course, this is not advertised also. When you buy your lottery ticket, it doesn't say on the ticket what is the probability of you winning.
It actually does.
It does?
Yeah.
Okay, I need to buy one then. I'm too rational, I never bought one. So, sorry for that. Another example was the example of the tech stock bubble, technology stocks. New technologies, it's very difficult actually to apprehend whether these technologies are going to work or not. And the probability of them working is probably very low. So one of the factors that we can actually use to explain the tech stock bubble is the fact that these technologies have lower probability to actually succeed. There's a pretty high probability that these firms will go bankrupt at the end, and the investors on the market would not apprehend that. So this is the second preference-based explanation. I have a third one with a lottery example, another one. This time, we are going to assume that you have your lucky numbers. You have been using the same numbers forever. You have your birth date in there. You have whatever numbers are important for you, you're using in there. And you've been playing every week for months, for years maybe, the same numbers all the time. You have not yet won. Maybe one day, but not yet. A friend comes to you and suggests a different set of numbers. Tells you, well, your lucky numbers are not good. I have better lucky numbers. You should play these numbers. These are going to make you win. Are you going to switch numbers? It doesn't matter. So you're going to stay with your numbers, right? Why is that? It's called the fear of regret. You don't want to regret. And there's actually in psychology 2 different types of regrets. The first one is called the regret of omission. Regret of omission means that you're sticking with the old numbers and the new ones win. Your friend's number win. But you said too bad. Sorry? Regret of commission. This is going to be very painful. You switch to your friend's number and your old numbers win. That's extremely painful, right? Regret of commission is way more painful. You don't want to regret. So when all your friends are making more money just by living in their house rather than you going to work every day and with all this pain every day, you want to be in the ride with them. You also want to buy a house and actually be able to enjoy the ride and make money on your house, make money in the real estate market. You want to buy more apartments. You want to be there and make a lot of money with that. You want to buy technology stocks when the prices are going up forever until one day the bubble bursts and then the decline is very rapid. So that's another explanation here for bubbles. And this is with the fear of regrets. Now we're going to move to the exposures that were the positions that were maintained by financial institutions. So we're going to try to understand the rational explanations first, and then I'll move to a behavioral explanation. Why did the banks, the insurance companies, were keeping such large exposures, so much risk in their portfolios? First reason, and that's something probably that you have in mind, is called the bad incentives reason. What is the bad incentives reason? Traders, executives in company were actually compensated in very large parts, in particular with their bonuses, on the profits that they were generating for the company. So when their positions were actually profitable, they would get a share of that. If they were making losses, they didn't have a bonus, but they wouldn't have a negative bonus. So they wouldn't have to repay part of the losses. So all of the incentives for the traders, for the executives, were to take as much risk as possible. Because if you're taking more risk, it's the first principle in finance, right? When you're taking more risk, on average, you're going to get a higher return from the financial markets. So if you get a higher return on average, there's more chances that you're going to get huge bonuses. That's what I call the lack of proper compensation scheme. And this is a story that's been in the news all the time, right? To explain these huge exposures. So that's the first reason that we can advance, which is a very rational one. Second one is called the bad models reason. What is the bad models reason? It says basically that the models are not well designed, that the quants, you know who are the quants on the market, the people actually working on these models, implementing these models for the trading rooms, they were accused of implementing bad models. There was too much opacity, a lot of exotic instruments. Nobody knew exactly what they were, where they were hidden. Too little understanding of what was going on with these models. And then the ratings of these exotic securities, Chairman Bernanke talked about that, right, with the CDOs, the CDS on the market. The ratings by the rating agencies were in general very high, AAA ratings for exotic securities, and we're not quite sure about the amount of risk that was in there. That's the bad models reason. Is it always the case that we're going to get rid of the models altogether on the markets? No way. It is just not going to happen. But what we want to make sure is that we understand that we need to really understand the markets. We cannot use models on the market without a complete understanding of these models. So whoever is using models need to understand them. And of course, this is where education becomes even more important. So this is something that comes back to the business schools, I believe, in the way that we need to teach these models before people go on the market and actually use them. Because we want to make sure that everything that is implemented out there is completely understood by the people who are using these models. The other rational reason, the bad luck reason. What is a bad luck reason? It means that, I don't know if you heard about this book by Nassim Taleb called Black Swan. And it basically talks about the impact of highly improbable things. So this would never happen. Probability is extremely low, but it just happens. So this was basically the story that was given by LTCM. Remember LTCM, long-term capital, the hedge fund that went bankrupt? It was just a series of bad luck at the same time, happening at the same time. The probability of these events happening are so low that nobody could anticipate that it would happen. A series of events, a catastrophe is always a series of events, right? A series of events that would happen with extremely low probabilities is just bad luck. It's a little difficult to be completely convinced by this story, actually, in the case of the financial crisis. So I don't know if I'll go with that, but this is something that has been advanced in the literature, so I wanted to mention it here. I want to provide here a behavioral explanation. And this behavioral explanation is about cognitive dissonance. And I want to start with an advertising campaign. Some of you knew that video already, right? I could see that some of you knew what was going on and what was coming up. You didn't. You were expecting an advertising for the car, right? Nice car, nice environment. The car goes behind the trees. You're expecting the car to come out of the trees. And everything's going fine. And then you see a monster coming up and screaming. What is cognitive dissonance? This is about the feeling of discomfort that you sensed when two inconsistent thoughts or ideas are coming together. So you were not expecting the monster, right? The monster, in a different setting, maybe you wouldn't be afraid of that, because you were expecting something going on that was very smooth and soft, and just the monster appeared. So this is that makes you extremely uncomfortable, and you will have to learn how to deal with that. The most standard example of cognitive dissonance is about smoking. I like to smoke. I know that smoking is bad. Smoking is bad for the health. I can die from it, but I still like to smoke. So I convinced myself that when I know these people, he lived till 95 years old, he smoked all his life, he was perfectly fine. I don't want to think too much that smoking is bad, although now it's written on the cigarette packs to remind you all the time that smoking is bad, right? But these two thoughts are conflicting. This is called cognitive dissonance. What about our financial crisis? How do we have cognitive dissonance in our financial crisis? Traders, bankers knew, for the most part. I'm having a very hard time to believe that they didn't know that their positions were extremely risky. They knew about it. They just didn't want to see that. So they knew that their positions could actually bankrupt their companies. But they liked making lots of money, right? At the same time, they also wanted to have a very good self-image. Everybody wants to have a good self-image, right? Everybody wants to believe that his job is valuable to society. There's nobody out there that would say, I don't care if there's a global economic crisis. Nobody would say that, and it's because of me. Nobody would ever say that, right? So these are two conflicting thoughts. They can actually bankrupt their company with their positions, but at the same time, they don't like thinking that they're the bad guys around. So these two thoughts are contradictory, and this is what we call cognitive dissonance. How do we solve that? How do we deal with it? The way most people deal with cognitive dissonance is by some manipulation of their beliefs. So as I told you, when you smoke, you want to remember the very old person who smoked all their life and it didn't do anything to them. When you're a trader and you have a very large risky position, what are you going to do? Most probably, maybe you're not going to assess the risk of your position anymore. Maybe all the tools you have at your disposal for risk assessment, you're not going to use them anymore. So you're going to hide that for yourself, not for the other people, but for yourself. You need to convince yourself that what you're doing is not bad. So it's a matter of self-conviction here. And of course, it was made even easier because of the complexity of the products. It was very difficult. It was all embedded, right? You had all these CDO, CDS that were embedded in each other. And because they were all embedded with each other, it's even easier actually to pretend that you don't know the risk that is attached to that because it becomes very complex. So there's some beliefs manipulation here. And of course, you see that with these beliefs manipulation, you can explain a lot of the exposures, risky exposures that were out there. I'm going now to the third section here about the amplification mechanisms. We're assuming here that the crisis began, and we know that the first trigger, it accelerated very, very rapidly. I was actually teaching in 2007, in the fall of 2007, a core course in finance here. And I had lots of trouble to teach what I was supposed to teach in the syllabus because every time I went to the classroom, there was a new huge event on the financial markets that I needed to talk about. And at the same time, I needed to cover whatever I was covering, right? Because these are the background for the finance students. It was very important that I would cover that. But this was a very challenging time for me, in that case, just teaching the syllabus. So let's try to understand these amplification mechanisms, and I'm going to refer here to the Ellsberg's paradox. It's a very known paradox in economics. We're going to assume that we're going to draw a ball from a bag, and we have a big bag, and it contains 50 red balls and 50 black balls. And you're drawing a ball from that. If you get a red ball, you get a $1,000. If you get a black ball, you get $0. How much are you willing to pay to play this game? Who would pay $1 for that? Who would pay $10? Who would pay $100? $200? $250? $300? $350? That's interesting. You don't want to
I would go-
bet first?
I would go all the way up to 5.
All the way to 500?
Yeah.
There's
Yes.
$4.99.
If it's 500, your expected return is 0, and you're incurring risk. You're not getting paid for it.
Let's say, take an average here. Let's say that 300 is the average in this room. So $300 to play this game. Okay, I'm repeating the game. The only difference here is that I have a bag containing 100 balls. Some of them are red, some of them are blacks. But I don't know how many reds, I don't know how many blacks. The only thing I know is that the number of red and blacks is random. Completely random. If you draw a red ball, you get $1,000. If you draw a black ball, you get 0. How much are you willing to bet? $1. 10. Wow, I'm losing lots of people here. 100. 200. Would you bet on average more or less than in the previous case? Less. Everybody kind of agrees on that, right? You would bet less.
I would do the
on
same.
average. You would do the same. Very rational. Most people actually bet less on average, although the same should actually be the right answer. Mathematically, if you compute that mathematically, the same should be the right answer, because the number of red balls is random. So if you take all the cases and you assume that, and then you compute whatever it is, you should find exactly the same number. Yes,
Could
ma'am.
you argue that having it be a random number of red and black is another element of risk? So maybe you'd want to decrease your price to compensate yourself for that risk, even though the average of the expected would still be 50 red and 50 black. There's an element of risk there that you would want to be compensated for.
Actually, there's not any other element of risk. I'm going to convince you with doing something new. I'm going to flip a coin now. Heads, you're going to draw a red ball and get $1,000. Tails, this is when you draw a black ball that you get $1,000. So depending on the results of me flipping the coin, you're going to have either the $1,000 with the red or the black ball. How much are you willing to bet in that case? Same thing than initially, $300 on average, we said, for the class. So that's interesting. We're adding some uncertainty to the uncertainty, and then it resolves the uncertainty. In other words, by adding more uncertainty with me flipping a coin here, I can actually go back to the situation where I had 50-50. So what is it that we don't like in that, psychologically? Because this is a psychological issue here. Psychologically, what we really don't like is what we call the difference between risk and uncertainty. Probably one of the first time that you heard that there's a difference between risk and uncertainty. It's a matter of definition only. So what would be risk? Risk is quantifiable. What does it mean? It means that you can assign probabilities to risk. So it's the first case. You know that the probability is 1/2. So it makes you more confident into going on and playing the game when you can actually assign probability. Uncertainty, you cannot assign a probability. So it's not quantifiable. People don't like uncertainty. You like to be able to feel in control. You like to flip the coin because you can feel that you know how to flip the coin. You like to play blackjacks because you make some kind of decision when you're playing. Feeling in control is something that is more valuable, which means that when uncertainty becomes more important on the financial markets, people tend to freeze. And this is exactly what we observed during the credit crunch. When credit was no longer available, nobody knew what was going on, everybody lost track of the probabilities of events. And in that case, everybody's freezing and just waiting to see what's going on. This is what we call ambiguity aversion. We don't like ambiguity. So we're willing to take risk as long as we can measure it. When we cannot measure the risk, we're more in trouble. Amplification mechanisms. Suppose another example that you face a choice between a sure loss of 7,500 or taking a chance that there's a 75% chance you will lose 10,000 and 25% chance you will lose nothing. What do you like better?
You take the chance because the expected return is the same as sure loss, so you might as well.
That's right. Most people would take the chance. Yes, David?
Well, I was going to say 1.
Oh, okay. It would actually be the rational decision. But I'm not asking you for your rational decision here. You understand that's not what we're doing today, right? I'm asking you for your instinct on that. And the instinct is to say, well, I really don't like losing money. This is big amounts of money, right? So I'm going to try to get a chance not to lose anything. And most people, just because of that, because you have 1/4 chance of not losing anything, most people will choose 2, although that is not the rational decision. So it's not a matter of the rational decisions here, but the matter of the actual decisions. Most people choose 2, and this is what we call loss aversion. When you start losing money, you're really unhappy. And in the real estate market, this is something very important, loss aversion. Why is that? When you want to sell your house and the real estate market is down and keeps going down very rapidly, and you always remember the price you paid for the house, and now the price is here, and this difference of price is your loss, right? You're trying to hold on to your house as long as possible. You don't want to lose money. So you're trying to hold on, and it's only when you're absolutely desperate that you're actually putting your house on the market and you accept the loss. What does it mean? It means that it's going to amplify the decrease of the prices. And that's becoming more and more important. The loss aversion is not even constant. It becomes more and more important when you lose more and more money. Yes?
Isn't there like a similar concept where if your losses are so great that it would make you go bankrupt or make you foreclose, then you would rationally take more risk with the chance that you might be able to get out of it, and then the downside is you're still bankrupt or foreclosed upon, you're just as poor off as you were before. So wouldn't that make that second decision the right case? Like, let's say instead of it being $7,500 loss and a $10,000 loss, it was losing your home or losing your home. Obviously, you'd pick the second one because there is some small chance that you won't lose your home.
That's right, but if you can avoid to be bankrupt at the same time, that would be your preference, because it's going to be even more difficult. You know, if it's only losing your home, that's one thing, but if it's also going bankrupt at the same time, then it's going to be very hard to go back on the market. So to some extent, that's right. There's it's not as clear than this simple example, but you're becoming more and more loss averse as you're losing more and more. Regulation and behavior issues very rapidly. It's quite interesting, actually, that there's very little literature on that. And I was thinking that this is maybe a topic for papers for you that would be really interesting, is to look at all these behavioral issues and try to understand how that can impact regulators and the Fed in particular. Regulators are subject to the same, well, they're human beings. So they're subject to the same behavioral biases. In general, they're better educated than the general public, but still, they're human beings. So sometimes, it's not because you know what should your decision be if you were rational that you're still not doing a decision that is rational. So you can still have irrational decisions even when you know what the rational decision should be. And then the second step to that is that regulators need to be aware of these behavioral biases because they need to understand better how to design efficient regulations that would take these into account. So I'm not saying here, by no means, that behavioral issues are the only drivers on the markets, right? I gave you a lot of rational explanations as well. But these are drivers that shouldn't be neglected, especially in the case of financial crisis. Because I do believe that it's more important in the case of extreme behaviors, financial crisis, than it is when the markets are pretty steady. Conclusion, what did we learn today? Well, 3 main points here. The market bubbles with all the different examples. Restriction on short sales was the rational one. Anchoring over extrapolation, overconfidence, overestimation of forecasts. The brain overweights very low probabilities and the fear of regret. Bank, large exposures, bad incentives, bad model, bad luck. And then cognitive dissonance and greed. Amplification mechanisms with the ambiguity aversion and the loss aversion. To conclude, we understood from the 4 lectures of Chairman Bernanke the importance of the Fed's decisions on monetary policies for economic stability and for financial crisis situations. We know that any declaration by the chairman of the Fed has huge impacts on the market. It is not always completely rational, but this is a fact. The markets are listening to all the announcements. So sometimes you can think that this is a behavioral biases from the market, right? And then we also heard Chairman Bernanke saying that financial crises were unavoidable and that we should prepare to probably have more. And I would very much agree with that, but what's really important, I think, for our future is to learn the lessons from the past. And whenever we see financial crisis, it's very important to spend time to analyze these financial crises, understand what was going on, understand how the regulations can actually be better tailored to avoid these financial crises. Doesn't mean that we're not going to have another one later on, but maybe we can avoid lots of them in the future when we learn a lot from the past. So that's how I wanted to conclude for the lecture today.
Any final questions?
Yeah, go ahead.
Yes.
When you were talking about like black swan events, you said it was like a rational idea of like just a series of bad luck happening. But isn't like the black swan theory focused on the fact that one black swan event, one single event, can actually invalidate or shift the bell curve because things aren't, events aren't independent, but there's correlation, especially during like extreme moments. So wouldn't that be like a legitimate kind of basis of looking at the financial crisis?
Yeah, this is a very good point. Actually, one way to look at the financial crisis when you're looking in a more technical way to the CDOs, for example, the way they were structured was very smart technically in the way that you had different trenches. And by having different trenches, you could actually manufacture AAA CDO from 2 CDOs that were AA only, for example. the problem that most people didn't see is that in the case of a bad event, the correlations are going to change between all of the financial securities on the market. And because the correlations are usually going up, there are much less diversification effect in the portfolios and a way higher probability of these events being amplified. So I didn't want to go too technical in all that, in my presentation today, but this is something that we did observe on the market, which is a shift in the correlation in the case when the financial crisis is starting. And because of this shift in the correlation that was not accounted for, the AAA ratings did not stand anymore. So you're right, and that's something that should be analyzed more precisely in the financial models.
Okay, very good. I'm not sure what behaviorally one would make of this, but last night I was trying to get myself settled down to go to sleep, and I was doing some channel surfing, and I ended up stumbling across a movie called Black Swan, where there was two ballerinas who got into a fight. One was strangling the other, and then the other stabbed the other one with a piece of glass from a So yeah, that's all I saw. I was like, this is not the way that I want to go to sleep tonight, and so I changed it. And as soon as you said Black Swan, I was like, wow.
This is not the movie from this book. Completely different.
So anyway, we are now halfway through the class, and the first half of the class has been focused on economic financial issues with the chairman and this week's presentation. But Isabelle has also done a great job of segueing us into the second half of the class, which we're going to be looking at other factors, other issues as they impress themselves upon the market. So behavioral issues are one. When we come in on Tuesday, we will continue the interactive dimension to it because Todd Peterson will be here, and as a law professor, Todd doesn't lecture. He just asks questions. That's what law professors do. And so I would be prepared for lots of questions and Socratic method, and we will talk about, or he will talk about, or we will discuss whether the Fed is even constitutional or not, and what difference it makes whether it is or whether it's not. Okay, have a good weekend, and we'll see you on Tuesday.